It's training live. It is the 16th of November 2015. My name is David Hickson, and as always, before we take a look at the markets, please make sure that you have read and these disclaimers. In this week's webinar, I thought that I would take a look at a slightly longer term picture for the US market, the S&P 500, or in fact, I'm going to be showing you data for the SPX, which is of course based on the S&P 500. And I thought we'd take a look at a longer term analysis, and this is not my analysis. That's my first disclaimer. I received a very interesting email from a very experienced Hurst cycles analyst discussing the longer term outlook for the SPX and asking some very interesting questions, which I thought that I would share with you, and we could discuss the analysis and take a look at what might be happening in the US markets. And of course, in many ways, the US markets are just a small subsection of the stock markets around the world. And so what we determine is probably happening in the US markets will have a very big impact upon your analysis on the European markets and stock markets all around the world. Let's start off by just catching up with the analysis that we've been looking at in the webinars we've been doing up to now. Here is data for the ES futures, and let me just zoom in a little bit. You can see this data goes back to 2007. I've spoken in previous webinars about how I'm not terribly concerned about looking at very long-term data, and perhaps that's one of the things that I would like to discuss a little more in today's webinar. Some people are very worried about getting a lot of data. Of course, to some extent, the more data you have, the better your analysis will be, because you're able to know more about what the cycles are doing. That's an undeniable truth. But to some extent, getting more data does not always equate to having a better analysis. And I discussed in our previous webinar how it's a situation of diminishing returns. As you get more and more data, yes, of course, your analysis will improve slightly as you get more data, but it improves less and less as you get more and more data. So it's a situation of diminishing returns. I like to work with at least 10 years worth of data. My absolute minimum for the amount of data that I'm happy working with is about 3 or 4 years. And I will only work with 3 or 4 years worth of data if I'm able to look at other instruments in the same or similar markets and know where the longer cycles probably are. So here is the analysis we've been looking at, and we've discussed it many times. And let me just pop up the circles there, and again, just do some of the basic details. Of course, the very important trough in March of 2009 has been identified by this analysis as being a trough of the 4.5-year cycle. Now, it is probably also a trough of the longer cycle, the 9-year cycle. So why doesn't Sentient Trader show me a 9-year cycle trough there? The reason is because there simply isn't enough data. I could, as a matter of interest, tell Sentient Trader to position a 9-year cycle trough over there, even though it doesn't have enough data, but I won't bore you with the details of that right now. The important thing is that we have seen 1 and probably 2/3 of the 4.5-year cycle elapse since March of 2009. So here's the 4.5-year cycle. It is this orange here, and let me point the arrow at the semicircle. So the first 4.5-year cycle went up and then came down into, according to this analysis, about November of 2012, and then it bounced up and reached a peak and is now heading down again. The semicircles are very useful, of course, in my opinion, for visualizing what the cycles are doing. The first thing you'll notice if you're new to Hurst cycles analysis is that the price movement didn't seem to go up for the first half of the 54-month cycle. Well, it did go up for the first half of the 54-month cycle, but it didn't really come down for the second half. Let me just clear that and make it a little more obvious. For the first half of the 54-month cycle, price was clearly coming up, but for the second half of the 54-month cycle, it wasn't clearly coming down. Yes, there were some fairly large moves down between October of 2010 and October of 2012, those 2 years. There were some strong moves down, but it doesn't clearly, price doesn't clearly move up, form a peak, and then move down. And the reason for that, if you're new to Hurst cycles, is very simply because of the longer cycles. Cycles tend to get squashed by the longer cycles, and so the longer cycle in this particular instance is what called 9 almost certainly did, was going up, for all of this time, is possibly still going up. And no, I'm sorry, it cannot possibly still be going up. It would have been going up for this time, would have turned somewhere there, and is heading down into the trough over here. So the 9-year cycle, and I've made rather a hash of that drawing, but the 9-year cycle, assuming it formed a trough over there and came down to a peak, came down to another trough, will come down to another trough over here. The 9-year cycle was driving upwards, and I use these semicircles a bit like vectors. You can sort of draw vectors off those semicircles as tangents, and you can see what the cycle is doing. And so because the 9-year cycle is pushing up, potentially even a longer cycle, who knows, maybe even the 18-year cycle, but we don't know that looking at this data. But there were longer cycles, or a longer cycle, that were pushing up, and because those cycles were pushing up, the 54-month or 4.5-year cycle was distorted, and so that's why we don't see a clear up and then down. And that's the nature of analyzing markets using Hurst cycles. Okay, so the next sort of prominent feature about this analysis is that, of course, we are about 2/3 of the way through this 54-month cycle, the trough of which was in November of 2012, and we're heading down now to a trough which is expected sometime in 2017. That's according to this analysis, and I have a very interesting long-term analysis I'm going to share with you in a moment, and it presents quite a different picture. So before you start saying, no, wait, hang on, what about this, what about that, let's just go through with this thought process and then compare it to the other analysis, and we have some very interesting conclusions to draw, I believe. So where are we in this 4.5-year cycle? Well, this 4.5-year cycle breaks down this nominal model, which is the list of cycles that we use. It breaks down into 3 shorter cycles. Each of those is 18 months in duration. And you can see here is the first of those 18-month cycles, which formed a trough in October of last year. And here is the second one of those. Now, as you know, we've discussed various options in terms of the shorter detail of this analysis, and one of those options is that a very prominent trough that we saw in August or September of this year, and there are 2 very similar troughs there, so it could be either August or September. One of those could be the 18-month cycle trough, in which case we have seen 1 and 2 18-month cycle troughs, and so all we have 18-month cycles, I should say, and so all we have left is 1 18-month cycle to take us down into this big low. So that's the sort of bigger picture of this analysis that we've been looking at. And as you know, the beta version of Sentient Trader is a new feature called the Composite line. If I can turn it on, there we go. And let me just pull this down a little bit and slide the chart to the left. The Composite line effectively takes all of the cycle information that the software has as a result of performing the analysis, and it rebuilds the price. That's what it does. It takes that cycle information It knows the wavelength and the amplitude of all of the cycles, and it recomposes that information into a single price line. So past, we can see how accurately our analysis reflected what actually happened in the market. So here you can see this line, and I'm hoping that soon we're going to get an update on the beta version, which will have a brighter line so you can see it more clearly. But you can see how closely the line in the past fitted price action. There were a few occasions, particularly recently, there were a few occasions where that line deviated fairly greatly from price, which was an indication that the cycle analysis and all of that cycle information was not providing a very good model for the price action. It doesn't necessarily mean there's something wrong. It simply tells us that the cycle information was perhaps not enough to really tell us about what was happening in the markets. And it's interesting to know in this analysis that one particularly strong deviation was over here when the peak formed, and the composite model line went right up above price. The general shape is the same. Price is forming a peak at that point, and the composite model line is also forming a peak. But price dropped way down below the composite line, indicating that there was which is not reflected in our cycle model. So that's an interesting little detail. This composite line, as you can see, is telling us to expect a bounce up from the trough that we've just witnessed in August and September, and it's showing us another there, and we'll take a look in the detail in a moment to refine our determination of when that peak is likely to be. And then the markets are likely to come down fairly hard into this trough over here, which is, where is that, about the middle of next year, 2016. Then we're going to see a sort of a corrective move up, a bit of a struggling move up, before another drop down to a really prominent trough, which is expected, according to this analysis, in about the middle of 2017. So that gives us a very big picture. An important disclaimer, or an important point to bear in mind about this composite model line, is that it assumes that the cycles are going to keep beating with the same rhythm, which is a fairly important assumption to make, and you should be aware of it. We know that the principle of variation is alive and well. Cycle wavelengths are constantly varying. And in the article that I wrote recently for Traders World magazine, I discussed what I call the cycle traders paradox, which is that you're making all your decisions on the basis that the cycles are going to keep beating with obviously the same rhythm or a very similar rhythm. The paradox is that you also know that the principle of variation tells us that the cycle wavelengths and amplitudes are going to vary, because they do constantly. And so that is the paradox of being a cycle trader. You're making decisions on the basis of information that you know is going to change. It makes for a fairly interesting situation. So that is the bigger in terms of this analysis. This is the default analysis I've discussed in previous webinars. So I'm not going to dwell on it too much, because I have some very interesting analysis to show you in a moment. But let's just take a look at some more of this detail. In our previous webinar, I mentioned that our next trading opportunity, in my opinion, would be when the ES, the S&P 500, or all the US markets effectively came down into the 80-day cycle trough. There's the nest of lows for that 80-day cycle trough. When we last did our webinar 2 weeks ago, that cycle trough was a little bit earlier, I believe. I kept speaking about the first week of November. We were expecting the trough to form in early November. Of course, we're now in mid-November, and the trough hasn't formed yet. As you can see, price has come down. I don't think I've loaded any data yet from the morning, but no, there isn't any new data from this morning, but you can see how price, of course, has come down into what we are expecting to be an 80-day cycle trough. Now, we could dwell on the details, but let's not do that because I want to show you this bigger picture. I'm looking forward to getting to that point. But so for some weeks now, and I've been speaking about the first week of November or early November for some time, about it being a trough of some significance. Here you can see the composite model line at this level of detail has followed price fairly closely, so it provided us with a fairly good model for price action. You'll notice that just in a few weeks, price has exceeded the composite model line to the upside. Okay, you can see price jumped up quite a lot higher than the composite model line was indicating that we should expect. That doesn't indicate that anything's wrong. The cycle model that we have simply uses the wavelengths and the amplitudes that it has recorded, and it generates that price line. So all that it indicates is that there has been a bit more bullishness in the market than would have been expected by our cycle model. What are we looking at? And again, based on the very important assumption that our cycles are going to keep beating with roughly the same wavelength and amplitude, you can see that we are looking at a period of consolidation, really. We are looking at price bouncing out of this 80-day cycle trough over here, coming up to a peak over there in early December, coming down again, coming up to another peak in, if we go look at the time scale down here, about middle of January 2016. Now, if you've been watching the past few webinars, past 3 or 4 webinars, you'll know that in every webinar I've spoken about price action coming down into a trough in early November, and then we're looking at a peak in January of 2016. All of the analyses that I've looked at have indicated a similar outlook over the next short period of time. As we get more data, as the markets trade and we have more data to analyze, we're able to refine that analysis. But the important thing for me, the really useful thing for me trading Hurst cycles, is that you're able to develop expectations for what's going to happen in the market. As you get further down the road, as more time passes, as we have more data, you're able to refine those expectations. And our refinement at this point is that, yes, we're still expecting a trough now, a trough to form now. We're expecting price to bounce up, and we should get a fairly good long trade. We are also expecting a peak still in January. I've been expecting that peak in January for a long time. This analysis has changed slightly and is indicating a slightly higher peak in March of next year. So now that's new information. Why has that happened? Well, it's happened because of the new data that we have received over the last 2 weeks. As you can see, price has come up over the last 2 weeks, higher than was originally expected, and because of that, the software is constantly adjusting its analysis and its cycle model, and of course its outlook into the future. I don't get too hung up on exact price levels, particularly not when working with the composite model line. What is more important to me is knowing what to expect. And I have been expecting for several weeks price to come down into the trough that it's in the process of coming down into at the moment. It should be forming fairly soon. And then, of course, I was expecting price to bounce up again. For some time, I've been looking at January as being a likely time for a good peak to form. Now the analysis has shifted slightly and indicated that a more important peak might be in March. So that gives us something else to think about and to work with. After that March, you can see price drops down really strongly. Now, why is there such a strong drop in March? Well, let me just zoom back out again. The reason for that is, of course, that we are expecting, according to this analysis, Here's our nest of lows. We're expecting the next 18-month cycle trough in July of this year. And of course, then we have the next 54-month cycle trough occurring sometime in 2017. So this is one of the analyses that we've looked at. And one of the other analyses that we've looked at that I discussed in not last week's webinar, the webinar 2 weeks ago, our previous webinar, that was this analysis over here. And this analysis differs slightly. It doesn't differ very much as a matter of interest. If we plot those semicircles, the way in which this analysis mostly differs is it has a slightly different position for the 54-month cycle trough, which is over here. And I think you can understand by identifying the 54-month cycle trough during this period here was so difficult, because price was just heading upwards. The bull got hold of it and just kept going upwards. Somewhere in there, according to the nominal model we're working with here, somewhere in there must be a 54-month cycle trough. And identifying it is a bit of a guessing game. It's very difficult to really clearly identify that 54-month cycle trough. So that's one of the differences with this analysis. The other analysis is that the trough that we've seen recently in August and or September was a trough of 18-month magnitude. Okay, I spoke about this analysis in our previous webinar. It's a very possible analysis, a very viable one. And let's have a look at what the composite model line tells us to expect according to this analysis. And perhaps I should zoom in a little bit so that we can compare them with similar time frames. You can see that even though this is a different analysis, the difference between the composite model line projection, not that great. I'm just trying to get the scaling right so that we can perhaps I'm seeing a bit too far into the future. There we go. That's a bit more useful there. Okay, so the composite model line, what is it showing us? Well, first of all, the composite model line has followed price action much more closely. Can you see that? It's been much closer to, you can probably hardly see that composite model line. It's hidden by price. And so that tells us that the cycle model that has resulted from this analysis matches more closely the price action, which by extension means that this is better analysis because our cycle model matches more closely. It doesn't definitely mean it's a better analysis, I must add. There are times where your cycle model can look very convincing, but it turns out not to have been the better analysis. That's a subtlety. Let's not bother too much about that. Let's just zoom in a little bit more because there we go. I'd like to show you how the composite model. Okay, let me just lose that future. There we go. The composite model here also, of course. Let me bring that. There we go. Keep filling this chart. There we go. Okay, so the composite model was telling us to expect a move down into a trough roundabout over here. So that's all good. Price has moved down into that trough. This is the trough that I've been speaking about for some time now, the trough that we have been expecting in early November. According to this analysis, it's only a trough of the 40-week cycle, not a trough the 40-day cycle, I beg your pardon, not a trough of the day cycle. I don't worry too much about 1 degree of magnitude difference. A 40-day cycle trough is a good trough to trade using an end-of-day time frame, and an 80-day cycle trough is a better trough to trade. Of course, you expect price to move down more into the 80-day trough than you do a 40-day trough. But both of them are good troughs or good cycle trade. So we are expecting, according to this analysis, we're expecting the bounce up fairly soon, and we're expecting a peak in, I hardly even need to say it, January of 2016. So there's that peak in January of 2016 that I've also been speaking about for some time now. I hope you're beginning to get the idea of how useful it is trading using cycles. You can start diarizing when to expect turns in the market, which is something that I do. I know it's a bit odd, but I do have some time diarized January as being a potential turning point in the markets. Interestingly, this composite model line is also indicating that the price is likely to hold up until March of next year. So both of these analyses, thanks to the recent price action, have changed their outlook slightly. They are still both projecting peaks in January of 2016, but they are now also both projecting peaks in March of 2016. After which, of course, prices fall away, and we're looking for a trough to happen in about the middle of next year, then a rise up to a peak. But at this point, I stopped taking the composite model line too seriously. It's useful for looking on an end-of-day basis. It's useful for looking a few months ahead. I wouldn't go much further than that, because by that time we'll have so much new data that a projection made 6 to 9 to 12 months in advance is not really very useful. So those are the two seasons that we have in these webinars, and not very much has changed. As the price is coming down as we expected into a trough, which is expected to form round about now. It's going to be interesting to see what happens after price bounces out of this trough, because one of the very important differences between these two analyses that I haven't really mentioned is that according to this analysis, we expect to see new highs. Can you see how the composite model line is slightly higher than it was back in May of this year? So according to this analysis, we would expect new highs in the stock markets. According to other analysis, we wouldn't expect to see new highs. But we are so close to those recent highs of May of this year that I tend not to worry too much. There's a very interesting difference between Elliott wave analysis and Hurst cycles analysis. Elliott wave, as you know, and I'm going to have an Elliott wave expert join me on a webinar soon. I've been speaking with him. And Elliott wave analysis, and I'm not an Elliott wave analyst. I have studied, but not very well. As you know, you get 5 up, so you get 1, 2, 3, 4. I can't really write numbers with this pen. There we go, 3, 4, 5. Those are your 5 ways up in Elliott wave analysis. And of course, the rules of Elliott wave analysis are that wave 2, so this point here, cannot drop down below the start of wave 1. If it does, that changes your entire count, because that's an analysis breaking rule. So on the other hand, Hurst cycles don't have such strict rules, and so if a price came up and formed new highs over here, that would not completely change our analysis. Okay, it's one of the interesting differences between Elliott wave and Hurst cycles. Hurst cycles is a little more forgiving, perhaps. I see Taiwan says the current future graph is going up, but the previous graph shows it going down. What's the difference? Taiwan, I think perhaps it's just my zoom scale. Let me try and get the zoom scales the same for both of these. There we go. And so these are the two analyses I've been speaking about so far in today's webinar. I still have to get the really interesting long-term analysis, which I'm going to do in a moment. But so there's the future line looking forward to 2022. Okay, and the basic idea, although it is worth repeating that you should never make the composite model line too far into the future, because it's make assumptions about these cycles remaining over this period of time, which is something that's not true. It's not going to happen. But there's the general picture, and let me go back to the other analysis and do the same thing. Zoom all the way out again. Let me turn my pen off, and so here you can see the forecast here. You can see the difference with this forecast projecting higher highs in January of 2016, but it is projecting a peak and then a move down and then a move up and then a move down. So I don't think there are very big differences between those two. There will inevitably be some differences, of course, because the cycles are different in the two analyses. But the general picture between these two, I think, is the same. I hope that answers that, Taiwan. I think that was just a matter of the zoom scale. Obviously, as I zoom in and out, I'm showing different periods of time. So I hope you can see with both of those analyses, we're looking at very much the same thing. And so just to be clear, what are we looking at? We're looking at, let me just zoom in on more recent. We're looking at price bouncing up out of the trough that is expected to form soon. Okay, we're looking at price bouncing up and coming up to a peak in January and again possibly in March. January and March of this year, and then we're looking at price moving down again. That's really what these analyses are telling us. I do think it's a fall into the trap of of planning to sort of start in late June of next year, because by the time we get there and you're making your trading decisions, we will have a lot more data, and the analysis might have changed. The important thing for now is that we're expecting price to pass out of a trough, rise up to another peak in March, potentially a higher peak before price drops down again. Now, let me take a look at a much longer term analysis. And this analysis was shared with me by email, and I'm not going to say who shared it with me because I had actually heard that that it's okay for me to speak about it in today's webinar, but here is the analysis. I was traveling, as you know, over the last 2 weeks, and I only really got to study this analysis carefully. And so if you'd like to tell us a bit about the analysis, I can see John there. There you are, John. Hello. If you'd like to comment about this analysis was sent to me by John, and a very, very interesting long-term analysis. I'm going to do my best to give the bigger picture. John, if you have any points you'd like to make, then please do add them in. The first thing I'm going to speak about with this analysis is an analysis of the SPX, which is of course related to the S&P 500, and apply the bubbles. Are those the semicircles? There we go. Yes, there are the bubbles. Okay, so this is an analysis going back to 1982. So that's how many years? 33 years. So we're looking at 33 years worth data. And so, of course, because we have so much more data, we've got information about much longer cycles. So we could start speaking about the 18-year cycle. And let me just make something clear. When I speak about cycles, I speak about the 18-year cycle, the 9-year cycle, the 54-month cycle. That's because those are names that we've given those cycles so that we all know what we're speaking about. And the way this works is like this. Hurst defined what he called a nominal model, which is effectively just a list of cycles that he found active in the stock market. And he worked out the exact wavelength of each one of those cycles. When Sentient Trader performs an analysis, it works out the exact wavelength of each one of those cycles. But because Hurst's cycle theory works on the principle that there are a certain number of cycles that work together, they have harmonic relationships with each other, and they work together, then it became convenient to apply a name to a cycle. So we have become used to speaking about the 18-year cycle, which is the cycle that Hurst originally discovered that had a wavelength of 17.9 years. I still speak about it as the 18-year cycle. There's been a lot of discussion recently about what is the correct nominal model to use. And in this analysis, let's just cut straight to the chase. The nominal model that John has been working with in this analysis assumes that what I call the 18-year cycle in fact has a length of about 14 years. Okay. It might make it easier if we started speaking about it as the 14-year cycle, and of course sometimes we will speak about it as the 4. You understand, it is the cycle that fits into the nominal model at the 18-year level, if that makes sense. Okay, so the nominal model that John is using in this analysis has a 14-year cycle instead of an 18-year cycle. And as a result, the shorter cycle is a 7-year cycle as opposed to the 9-year cycle we keep speaking about. Now, applying this nominal model and performing an analysis with this nominal model provides us with a lot of very interesting insight, I think. And so let's just speak about the sort of bigger picture for a moment. Right, first of all, you can see here this red cycle is the longest cycle in the analysis, the 18-year cycle, or let's call it the 14-year cycle, because that's what it is according to this nominal model. It's a 14-year long cycle. Now, one of the things that I like to do when I start looking at an analysis is I start trying to identify the M shapes that cycles form in markets, because they do. And I keep banging on about them, but they do. They form M shapes. And when I see clear M shapes that are formed, then that gives me reason to believe that, in fact, the analysis is a good one, because M shapes form as a result of the combination of cycles that influence financial markets. And so there is a very clear M shape from 1994. This is 1994. You probably can't see that date, up until 2000. So that very clear M shape is the 14-year cycle. So 1994 until 2009 is a little bit less than 15 years, I think I'm correct in saying. Yes, can I show it in log scale? Yes, indeed, log scale is a much better way of looking at it. So let's click that log scale button. Okay, there we go. And let me just hide that cycle toolbar. Okay, so now we're seeing it. A very useful way of looking at much longer term charts. And you can see the M shape even more clearly from 1994 up until 2009. So there is that M shape. Okay, so that's the 14-year cycle, and of course the shorter cycle breaks down into 2 7-year cycles. Okay, so that's the sort of that scale of the analysis. Now let's just zoom in. In fact, before I zoom in, let me just say something else about the start. One of the very important things when you're performing an analysis is choosing a start date, and we've spoken about it before. But if you only show sentient trader data after 1990, for instance, then if I don't show that data to sentient trader, then it will assume that the trough in 1990, a very prominent trough in 1990, was probably a really important trough, perhaps more important than it turned out to be. If you choose 1994 as your starting point for the analysis, so you're not showing sentient trader any of that detail, then again, 1994 trough will be possibly given more prominence than it deserves. I say possibly because not necessarily. 1994 was a very important trough, and I don't think we're going to have time in today's webinar to look at the abilities. But John shared with me analyses with start dates in 1994 and in 1990, and also in 1982, and you can see with the different start dates how these analyses nevertheless come up with fairly similar wavelengths that are active in the markets. In fact, I see John's put in a comment there about that, about how you'll get different views. And you obviously get a slightly different analysis because of the extra data that you have. But let me just show you, I think I have here, for instance, the 1994 analysis start date. And let me zoom all the way out. The 1994, and let me put on the semicircles. There we go. The 1994 analysis doesn't actually draw the 14-year cycle because it doesn't reckon it has enough data to do that. But you can see here the M shape. And so although we have a different analysis start date for this analysis, we nevertheless are finding the same cycles effectively in the markets. And when you see that kind of thing happening, when you have different start dates show you effectively the same cycles, that's a really good indication that you're onto something good and that your analysis is a good one. When you get different start dates and your analyses are completely different, and there's no similarity between them, completely different cycles, then that, in my opinion, is an indication that perhaps you really haven't got cycles right in the market. Let's take a look at this one, this analysis here, which of a mess, and let me. There we go. And just pull that up again. This is with an analysis start date in 1990, and so the things that immediately jump out about this analysis is this really important trough over here is over there. Okay, well, yes, what was that? That was 1998. So yes, that move down in 1998 was a bit of an important move down, but was it more important than the trough in 1994? And when you're only showing the software this much data, it's quite difficult to distinguish between those two troughs and say which was really the most important. But looking at the analysis with much more data, we can say fairly clearly, and here's the data, the analysis going back to 1982, we can say clearly that in fact 1994 trough was almost certainly the better, the more important position for that trough. So this analysis, the first really interesting point that it makes is that the nominal model that has been working in this market, and we can look at the details of this analysis, which we will do in a moment. But one of the really important things that it points out is that since 1982, for the last 33 years, the nominal model that has been working well is a nominal model with 14 years, and then 7 years, and then of course 3.5 years, and so on, shorter and shorter. So that's the first really important point to make. Let's zoom in and have a look at what this analysis tells us has been happening recently. The interesting thing is that, of course, in March of 2009, we also, in the other analysis, had our trough of, I've been speaking about it as a 54-month cycle trough and probably a 9-year cycle trough. And there's no difference in this analysis. This analysis shows us those same cycles, the orange cycle and this reddish cycle, also troughs in March 2009. This analysis tells us that the even long cycle, in this case the 14-year cycle, also formed a trough at that point. And I see David asking whether 1982 is possibly a nominal 54-year low. That's a really interesting point to quickly zoom out. I probably wouldn't be able to speculate on that, but it's if we step up from the 14-year cycle, we would get to probably 28. Or do you have a nominal a harmonic ratio of 3:1? I don't know, but yes, it's an interesting speculation to make that is the 54-year cycle low. So you'd have a 3:1 ratio. That's a fascinating discussion. And I see Robin says the troughs could look clearer in inflation-adjusted S&P chart. Yes, it's a very interesting point because inflation-adjusted charts do give you a clearer picture very often. So it's a very interesting point to make. So let's have a look at what this analysis says has been happening. As in all the analyses we've been speaking about today, March of 2009 was a very, very important trough. This particular analysis tells us it was also probably a trough of the 14-year cycle. Now, I mentioned earlier how the 54-month cycle, and I'm going to continue calling it the 54-month cycle because I'm so used to calling it that, but it's this orange cycle, the 4.5-year cycle, which is now in this analysis 3.5 years. That trough formed over there, and again we get a situation where you don't get that price going up for half of that cycle and then coming down for half of the cycle, and that's because of the longer cycle squashing it. I mentioned that earlier in today's webinar, and in this case you can see very clearly there are two longer cycles squashing it. This cycle here, which is the 7-year cycle, which is heading up, and this cycle here, which is the 14-year cycle, which is also heading up. Those two cycles, very long cycle wavelength cycles, are very powerful cycles, and they give us a very good reason, a very good explanation for why the 54-month cycle trough was a disappointing affair. As a matter of interest, they also provide us with a clearer picture of what is the channel pause. And I'd like to spend just a moment speaking about the mid-channel pause because it's quite an important aspect of Hurst cycles. And so if you bear with me just for a few minutes, it's a very important thing to understand, particularly when you have cycles moving up strongly, and quite a lot of relevance to what's happening at the moment in the markets. Okay, a mid-channel pause, what is it? Well, we expect cycles to make M shape. So looking at this a very long, in this case 14-year cycle, the red cycle, the M shape that is going to be made, or that has been made so far, we had price rising up to the first peak and to come down to the trough. We don't know where the trough is yet, and let's not get bogged down by details, but then it goes up again and then it comes down again. Okay, so you get your rough M shape. All right. Within each of those up and down moves, again, you expect an M shape. So let's see if I can change the color of this pen and make it white. So if we look at the 7-year cycle, it is also going to make an M shape. It's going to rise up, it's going to come down, it's going to rise up, and the same thing is going to happen on the downside. So the 7-year cycle is also creating an M shape. And so if I combine the shapes of both of those cycles, the 7-year and the 14-year cycle, then I end up with a line that looks a little bit like this. It goes up, it comes down, it goes up to a peak, it comes down to a trough, goes up to a peak, comes down, and so on that side. Okay, so you see in the M shape, in the first move up and in the move down, you get a wobble. All right, so you get price moving up and then you get it moving down again, and that little bit of a wobble is what Hurst called mid-channel pause, and it occurs at around about the time on the way up. It occurs at of the trough of 2 cycles shorter than the longest cycle, whose shape, sorry if that sounds a bit complicated, let me just re-express it. So the cycle shape that we're looking at is the 14-year cycle, this red cycle here, and of course we expect, roughly speaking, an M shape, but at the cycle 2 degrees shorter, at the trough of the cycle 2 degrees shorter. Now 2 degrees shorter than 14 years is 14 years, 7 years is the next shorter cycle, 3.5 years is the shorter cycle. So that's 2 degrees shorter is orange cycle, the 3.5-year cycle. When that trough forms, you expect to see a mid-channel pause forming. So the mid-channel pause tells us that price will come up and then it has a wobble. and it forms, of course, the trough of the 3.5-year cycle, and then it moves up again. So, in fact, this period here, and let me just rub that out, this period over here, when many people who are new to Hurst cycles would look at it and say, but why isn't that a long, powerful 3.5-year, 4.5-year cycle coming down to a more impressive trough? The reason is because it was probably engaged in what Hurst called a mid-channel pause, during which time price doesn't really come down strongly into a trough. It really pauses in upwards movement. That's the important point. And so we have a strong upwards movement, of course, and in the middle of that movement, a pause, which is this area over here. So that's the mid-channel pause. What is the importance, what's the relevance of that to today? Well, because price could be breaking out of a fairly long cycle trough at the moment, and what we might be looking at forming soon is another mid-channel pause. So we might not see very strong price action moving downwards. We might see a mid-channel pause forming. But before we take a look at that in further detail, let's continue discussing this analysis. So we have the same thing as we have in all of the other analyses that we've looked at today. According to this analysis, a lot earlier, because cycles, the yellow ones, 1, 2, 3, into that trough. Let's zoom in again and take a look at what has been happening since that point. And here we're beginning to see a little more detail. And let me keep those things on for now. Okay, so here you can see the 18-month cycle troughs. Of course, they're shorter than 18 months. They also run at about 14 months. And the first one was over here in June of 2013. The next 14-month cycle trough was here in October of last year, 2014. Can you see how, in fact, this analysis is really very similar to the other analyses we've been looking at? The only difference is that the cycles are all running slightly shorter. And here's the big punchline for this analysis, and that is that this big nest of lows that you can see over here, which is a nest of lows for a 7-year cycle, is just about upon us. So in the other analyses looking at, the analysis that I've been discussing for some time, that longer term nest of lows is, I've been talking about it happening middle of next year, perhaps 2017, so it still lies fairly far ahead of us. Big difference, and a very important difference with this analysis, is that 7-year cycle trough, it's forming a very nice, neat nest of lows. I love an analysis when it has a neat nest of lows like that. It's often a very good indication that this is a good analysis, and that is lying just ahead of us. Let's zoom in, and okay, I see John. John saying he would expect an important low by early next year. Could already be in with the August low. So that's the burning question of the moment, isn't it? Here we've got a beautiful nest of lows. I don't know if I'm the only person who finds charts beautiful, but look at this nest of lows. As you know, a nest of lows is formed by the circle and whiskers. The circles tell us the exact time of the next trough of a particular cycle. The whiskers, or lines to each side of the circle, tell us the expected range of time. Given the principle of variation. So, obviously each trough, some people like to project troughs occurring at exact times and days, but using Hurst cycle theory, generally you can only project a trough to occur at a certain within a certain range of time. And this is an extraordinarily accurate nest of lows. By that I mean that these cycles are lining up in a very straight line. Can you see that? It's a really extraordinarily accurate nest of lows. When you see a very accurate nest of lows like that, it indicates that the found have recently been beating with very accurate harmonic ratios. So when you project them forward, look at this 18-month cycle. The next 18-month cycle is expected on pretty much exactly the same day as the next 40-week cycle trough, and the 20-day trough is just a few days earlier, not even a week's difference. I see Robin saying, are the cycles running short or long in this analysis? They are running short according to what I call Hurst's nominal model. Hurst's nominal model has an 18-year cycle. This has a 14-year cycle, so they're running short. Running short. So anyway, we have a very beautiful, very accurate nest of lows, which tells us that this analysis is really worth looking at. Is that nest of lows providing us with a very accurate target for the date of the turn? No, in my opinion, it isn't. There's a really subtle point that I'd like to make. Over the years that I've been doing this, and I've been looking at nests of lows, Trader's oldest user. Well, I mean, I've been using Sentient Trader for longer than anybody else. In fact, Sentient Trader's oldest user was somebody who did Hurst's original cycles course back in the 1980s. I had the pleasure of speaking to him. That's a complete aside. But the really important thing is accurate, or very neat nest of lows like this. It doesn't necessarily, in my experience, indicate a very accurate target. You shouldn't set your watches and your trading according to that target. What it does tell you is that recently the analysis has been, the cycles have been beating very, very correctly in terms of the harmonic ratios between the cycles and the wavelengths of those cycles. So it indicates a tremendous accuracy in the analysis. It's not necessarily a tremendous accuracy in the target. That's a subtle difference, but it shows the analysis is very good. But you can nevertheless still get your trough occurring early. So that brings us to the burning moment. Is this trough that formed possibly the 7-year cycle trough that this analysis is telling us to expect? Now we've got a very accurate nest of lows here for early December 2015 in about a month's time. Of course, it's not impossible that the markets will plunge down, form a new low, and a perfect projection to that target. But in my experience, the fact that we've got a very neat nest of lows doesn't necessarily mean that target in December, that time target in December, is definitely, absolutely correct. But what it does tell us is that there's a lot of accuracy in this analysis. As John says, this analysis is telling us that we are expecting a 7-year nest of lows to happen before, by early next year. And it is possible, it is very possible, that the trough in August, or perhaps the trough in September, was the 7-year trough. You see, there's a very big difference there. In fact, I can count the bars there to when the next trough was expected. 66 days. Now, a 66 or 66-day error in projecting the trough of a 7-year cycle is a very small error. I won't try and work it out while I'm trying to speak live on air. I find that doesn't work very well. So that's a very small percentage error. So it is definitely possible that trough in August was a trough of the 7-year cycle. So this is a really interesting analysis. I'm sure you all agree. The last thing I would like to do with this analysis is quickly show you the composite model line, because I've added a composite model line to this analysis, and I would like to show you what it tells us. Okay, So let's just do that. Okay. Right. So here's the composite model line, and for this particular analysis. Now, first of all, there's a really strong, there's a really strong, is this 20 week or 80-day cycle there, which is causing that sort of very recent distortion. I prefer to ignore that because it's an over amplification of that recent cycle, which is actually a bug that we're in the process of fixing. It proves to be an extremely complicated bug to remove. So there we go. If we leave that out, then this is the bigger picture. Now here's the big surprise that this composite model shows us. The composite model line is showing us price coming up and following price fairly closely, and forming a nice rounded peak over there. I mean, it's giving all of that perfectly. It's giving us a trough over here. That is, of course, the trough of the 7-year cycle. Now, bear in mind that that trough might have occurred. It's just possible. Following the formation of that trough, we're looking at a bounce up like that. And if that trough did occur there, there's our bounce up. And then we're looking at the market moving down. Now, I'm sure that's a bit of a surprise to you. If we have a 7-year cycle trough forming now, then why on earth is the composite model line saying it's going to go down? Okay, it's a really interesting point, and the answer to that, the reason for this. Let me just zoom out. There we go, and let me zoom in. Okay, and bring that down. If I can, I'm probably going to crash the software now. Okay, there we go. So if this is if this is a 7-year cycle trough, then why on earth are we not seeing price bouncing up for the next 3.5 years? Again, it's because of the way that Hurst cycles work and the way that the cycles combine. The composite model line is taking the cycle information, it is reading the lengths and the amplitudes of those cycles, and it is simply putting them together. Now, I know I keep going on about these M shapes, but if the 7-year cycle trough forms over here, then there is the first part of the M shape of the current 14 cycle. Move up to a peak here. Look at that move down to the trough. It is tiny. And Sentient Trader has worked that out in its calculation of the amplitudes of these cycles. So what would our M shape be? A very useful place to start in creating an M shape is to start a symmetrical one, in my opinion. And well, that's not really very symmetrical, but you start with a symmetrical shape. And let me just zoom in here and show you on a slightly different scale. You start with a symmetrical shape for that shape, and then of course you can adjust it from there. But here is the symmetrical M shape. Okay, and so the fact that the 7-year cycle trough might have formed in August is not actually very good news for the stock markets. Most people who are new to Hurst cycles will say, oh, because there's a 7-year cycle that might have formed in August, that means we're going up for 3.5 years, right? Surely you go up for half the cycle and then you come down for half the cycle. So if a 7-year cycle trough formed, that's really good news. Well, it's not necessarily news. Now, of course, there are disclaimers to be made. The composite model line is not really projecting what's going to happen in the future. It's simply stating, as I've said so many times before, it's simply stating that if these cycles continue beating with the same amplitude and the same wavelengths, then this is what is going to happen. So let me just include cycles in the composite model and see how that affects it. Okay, you can see the very strong distortion caused by the recent week cycle. which is looking very strong. In fact, I have another little quick point to make about that. So let's make that now. Let me zoom in here and let's look at this. This has been identified as a bug in the composite model line, which is that it tends to over amplify the recent amplitude of a cycle. And in this case, it is the 20-week cycle. And let me turn my pen around, it'll work. Here you can see the composite model line is sticking very closely to price. And then here it's jumping up higher than price has, and then it's coming down really hard. That is an over amplification of the 20-week cycle. And the reason it is that is because price has moved up very strongly out of the 20-week cycle. And if you think about the composite model that Sentient Trader has in its memory, I nearly said in its mind, but it doesn't have a mind. The composite model that Sentient Trader has in its memory is that, of course, the 7-year cycle trough is the 7-year cycle is still moving down to a trough over here. If that 7-year cycle is moving down into a trough, then it must be pushing down very hard. Let's think about what all of these cycles are doing. The 7-year cycle is moving down. The 54-month or year cycle is moving down. The 18-month cycle is moving down. The 40-week cycle is moving down. The only cycle that has been moving up since August has been the 20-week cycle, and of course all shorter cycles. So there are 4 really long, powerful cycles pushing down. However, the 20-week and shorter cycles have been pushing up. What has Sentient Trader done? It has looked at this price movement, and it has said to itself, let me turn my pen back on again, it has said to itself, this strong price movement up has been caused 20-week cycle in the presence of 4 longer cycles all pushing down. So therefore, what is the 20-week cycle doing? The 20-week cycle has turned into a super cycle, and Sentient Trader is over amplifying that 20-week cycle. But that raises an interesting question, because that is actually what is happening mathematically in the cycle model if the 7-week cycle trough does still lie ahead of us. So in fact, that is another argument for the fact that this 7-week cycle trough possibly did occur in August. Because if that 7-week cycle trough still lies ahead of us in December, then why on earth has the market been going up so strongly? As you can see in the composite model line, Sentient Trader's answer to that question is that it is going up because the 20-week cycle has suddenly turned into a super cycle and has just developed a tremendous amount of bullishness. And that is why that composite model line suddenly goes so crazy. And I'm sure some of you who are beta testing the new version of Sentient Trader have seen that. You've seen instances where you get a sudden wild movement because of a recent very strong amplitude of a cycle, and it's because the logic of the cycle model doesn't really work. There's been a strong move up to August, and yet all 4 of those longer cycles are pushing down. So there's a discrepancy there, and that's why you get that sudden wobble happening there. I think I've missed a few questions there. The question will really lie in the longer term cycles beyond the 14-year shown. Okay, so we need to start looking at even longer year cycles. That's going to be interesting. It'll have to be a subject for another webinar. Could be an ABC to the downside or an M shape. Robert, I think I've sort of passed the context of that, so I'm not sure exactly what you were saying there. Robin, a nice W shape since the July top. Yes, okay, so of course we get M and we get W shapes. Merrill's MW cycle system is very, very interesting. You get M shapes, and then you get W shapes, and of course they overlap. The last leg of the M is the first leg of the W, and that's your constantly overlapping MW shapes. Very, very interesting Very, very interesting theory. I did some work with that. Okay, so in conclusion, when is the low expected? Taiwan asks. In conclusion, according to this analysis, we are expecting a 7-year cycle low to occur before the beginning of next year, by mid-December. However, Taiwan and everybody else, there is a fairly strong, I wouldn't say go so far as calling it evidence, but there's a fairly strong indication that that cycle low might have occurred in August or September of this year. It's very possible. So how do we deal with it? Well, let me zoom in on this chart and show you what the composite model is telling us to expect according to this chart. And of course, the data on the chart, I'm afraid, hasn't been updated for the last 2 weeks. Is that right? When does this data go up to? This data goes up to about the 15th of November, I think, or no, I think it perhaps only goes up to the end of October. So we're missing a bit of data. I haven't updated this data. But what are we expecting? Well, we're expecting price to come down into a trough. As I mentioned, that's a over-exaggerated estimation of the trough. But we are definitely expecting price to come down into a trough and to form fairly soon. What's more important, in my opinion, is to take a look at these points over here. Can you see this peak over here? That peak is at the end of January 2016. Now, if you have a fairly good memory, you might remember that I've been speaking about the peak in January of 2016 on the other analysis. And there was a change on the other analyses we've been looking at. It indicates March of 2016. And if we take a look at that peak over there, you can see that's April of 2016. So we have a really very interesting situation where we have two analyses that superficially, or not superficially, on a fairly deep level, are very different. They're using different nominal models. But both of them are indicating that we're looking at peaks forming in January or February 2016, and then again in March and April of 2016. Which is why I love Hurst cycles, because you can look at a variety of different analyses, and I'm still going to be looking out for a big peak in January and again in March. Of course, the big difference is what's going to happen over the very near term, because this analysis, if the 7-year cycle trough does lie ahead of us in December, then the move down that has started just now, recently, is likely to just keep going, obviously, into December. So how can you protect yourself against that? You protect yourself against that by making trading decisions on the basis of a cycle tool. In my opinion, it could be any cycle tool, the cycle tool of your choice. I like the FLD, and let me show you the FLD that I particularly like. It's the 20-day FLD, and so there is 20-day FLD, and so you would enter short when price crosses below this 20-day FLD, which it has done. We'll look at the other chart in a moment. And you coming down. If it's coming down to a 40-day cycle trough, as shown in this analysis, then you would expect it to bounce back up again, and you could potentially buy as it crosses up above that 20-day FLD. And then it will be expected to come all the way down into that big trough. So so the very important thing, in my opinion, let me just go back to our other analyses, our default analyses of the S&P 500 or the ES futures. The important thing is you first of all look at the analysis, and you make decisions on the basis of what you think the analysis is telling us is going to happen. And then, of course, you have to translate those into trading decisions. And here you can see the 20-day FLD. Trading using the 20-day FLD, we would have, I didn't because I was still in Rome, and I don't trade when I travel. It's just a rule I made for myself. But as price came down below the 20-day FLD, that would have been my entry point for the short trade, and I'm expecting it to come down into an 80-day cycle trough according to this analysis. My next trade would be a long trade as it breaks up above that 20-day. If in the next few days or weeks price crashes down, and just keeps coming down, then of course we know that it is very likely that the 7-year cycle trough is in the process of being formed. Okay, the important thing, of course, is to be on the right side of the market. Don't buy just because it's December and you think it's time to buy. You have to wait until you see your trading information in the evidence of the way in which price interacts with the cycle tools. That's the way I do it on an end of day basis. Okay, so let me just see. See, Robert has clarified his comment earlier about the M will be 3-wave or the center part of the M will be 3-wave or an ABC. Okay, and Robin, beta testings noticed the composite line over amplification seems to happen when ST is phasing a big trough or top too soon. Okay, that's interesting. Yes, it happens, Robin. I can tell you, it happens when because of the analysis, sentient trader works out that one of the cycles has got to be overperforming when it happens. Okay, and so I see there's a conversation with Robin and Sam. I know Sam's sorting out some beta testing issues there. Like to be able to unphase recent troughs or tops. Yes, that's an interesting point. In fact, the MetaTrader can do that very simply with the click of a mouse. Well, that brings me to an end of today's webinar. We've been going on much too long. Thank you very much for joining me, and I do hope you found it interesting. Thank you very much for your interest in Hurst cycles and in Sentient Trader. And please bear in mind that unfortunately next week I'm again not able to do a webinar. I'm presenting something at a conference, so I won't be able to do anything next week, but we will be back on the 30th of November. 30th of November we will meet again. So thank you very much for being here. Thank you for your interest in Hurst cycles. I wish you all profitable trading, of course, and be careful out there if that 7-year